Imagine you walk into your bank tomorrow morning. You've got $10,000 sitting in your savings account. You go to the teller, slide over your ID, and say, "I'd like to withdraw my $10,000 in cash, please." And the teller smiles, types something into the computer, and then says, "I'm sorry, sir, we can show you that you have $10,000, but we don't actually have the physical cash right now. We can offer you a receipt instead." You'd lose your mind, right? You'd be on the phone with a lawyer before you hit the parking lot. Well, here's the thing. That scenario, the one that sounds completely insane, is essentially what's happening right now in one of the most important commodity markets on the planet, and most people have absolutely no idea. My name is Smith, and I spend way too much time thinking about money, markets, and the systems that quietly control both. If you're someone who wants to understand what's really happening beneath the surface of the financial world before it shows up on the front page of the newspaper, hit subscribe and give this video a thumbs up, because today we are going deep on silver. Not the silver that trades on a screen, the actual, physical, hold-it-in-your-hand silver. And what I'm going to show you over the next few minutes is that the vaults are being drained at a pace that has never happened in modern financial history, and the implications of that are enormous. Let's start with a number. 820 million ounces. That's how much silver the world has consumed above and beyond what it has produced over the last 5 years. Since 2021, the global silver market has run a supply deficit every single year for 5 consecutive years. That's not a blip. That's not a bad quarter. That is a structural breakdown. And to put that number in perspective, the entire world only mines roughly 1 billion ounces of silver per year. So we have burned through the equivalent of almost 1 full year of global production just to make up the gap between supply and demand. Those missing ounces had to come from somewhere, and they came from the vaults. Now, you might be thinking, okay, supply and demand gaps happen all the time in commodities. Prices adjust, miners ramp up production, problem solved. Here's what most people don't realize. Silver isn't like oil or wheat or soybeans. You can't just flip a switch and produce more of it. New mining projects take 8 to 12 years to develop from discovery to production. And here's the part that really messes with most people's heads. Roughly 70% of silver mined globally isn't even produced by silver mines. It comes as a byproduct of copper, zinc, and lead mining, which means even if silver prices double, even if they triple, the miners who actually produce the most silver are not going to suddenly change their business model. They're mining copper. Silver just comes along for the ride. So the supply side is essentially fixed. And what's happening on the demand side? Oh, this is where it gets interesting. In 2025, global silver demand hit an estimated 1.24 billion ounces. Global supply, including all the mining and all the recycling, came in at about 1.01 billion ounces. That is a deficit of over 230 million ounces in a single year. To give you a sense of scale, 230 million ounces is the entire annual silver output of Mexico, the biggest silver-producing country in the world, gone just to cover the gap between what the world needed and what the world produced in 1 year. And the demand side is only getting more intense. Solar panels alone consumed 232 million ounces of silver in 2024. That number is up 5-fold from just a decade ago. Every single solar panel requires silver, not because engineers chose silver for aesthetic reasons, because silver has the highest electrical conductivity of any element on the periodic table, and there is no economically viable substitute at scale. Electric vehicles use silver. 5G infrastructure uses silver. AI data centers use silver. The more the world pushes toward a tech-driven, clean energy future, the more silver it needs, and the supply pipeline has no ability to respond quickly. Now, look, this is the part of the video where I need to talk about the vault numbers, because this is where theory meets reality in the most dramatic way possible. There are three major exchanges in the world where physical silver is stored, traded, and delivered: COMEX in New York, LBMA in London, and the Shanghai Gold Exchange in China. These three institutions are essentially the global clearinghouses for physical silver. When a company or investor wants to actually take delivery of real metal, these are the places you go. And what's been happening to their inventories should stop you cold. COMEX registered inventories, the silver that's actually available for immediate delivery, are down nearly 70% since 2020. 70%! In December 2025 alone, over 46.7 million ounces of silver were claimed for delivery in the first 4 trading days. That represented more than 60% of COMEX's total registered inventory, drained in 4 days. LBMA vaults in London have lost roughly 40% of their holdings. The amount of silver freely available in London dropped from around 850 million ounces to somewhere around 200 million, a 75% collapse. And Shanghai inventories hit their lowest level in a decade, with over 300 tons vanishing in October 2025 alone. Here's the metaphor I want you to hold on to. Imagine a swimming pool that's supposed to hold 1 million gallons of water. The pool has a small pipe filling it and a much larger drain at the bottom. For years, as long as the drain wasn't fully open, the pool stayed reasonably full. Now the drain is wide open and the pipe hasn't gotten any bigger, and the pool is 70% empty. That's the global silver vault situation right now. And then there's a layer to this story that most people in mainstream finance are not talking about: the paper to physical problem. Here's what most people don't understand about how silver markets actually work. When you buy a silver futures contract, you are not buying silver. You are buying a promise, a paper promise that says in theory you could demand physical delivery if you wanted. But historically, fewer than 2% of futures contracts ever result in actual physical delivery. The other 98% get cash settled or rolled into the next contract. The whole system is designed around the assumption that nobody is actually going to show up and ask for the metal. Now think about what that means at scale. The paper to physical leverage in London has been conservatively estimated at over 300 to 1. That means for every single ounce of physical silver sitting in a vault, there are potentially 300 paper claims on that ounce floating around in the market. Under normal conditions, this system works fine, but the moment people start actually demanding physical delivery, the math falls apart completely, and that's exactly what's been happening. Lease rates, which is the interest rate charged to borrow physical silver, tell you everything you need to know about how stressed the system is. Under normal market conditions, silver lease rates run about 0.3 to 0.5% annually. That's nothing. That's background noise. By October 2025, silver lease rates exploded to 39% in a single day before moderating to around 11%. And by January 2026, they were sitting around 8%. Think about that. Someone is willing to pay 8% annualized just to borrow physical silver for a short period. In a world where U.S. Treasuries yield about 4.5%, the fact that physical silver commands a higher borrowing rate than the U.S. government is a screaming signal that something fundamental has broken. Now, you might be thinking, okay, this sounds dramatic, but silver prices can't be that high if this is all true. And this is where the psychology of markets does something really fascinating and honestly a little maddening. Here's the thing about paper markets. They set the price of silver, even when the paper market is completely disconnected from physical reality. For most of modern financial history, the price of silver shown on your brokerage app has been determined by the futures market, by paper, not by the physical metal. And that has allowed a situation to develop where the paper price was suppressed well below what the physical reality would suggest. But that disconnect is starting to crack. Physical silver in Shanghai was trading at premiums of 12 to 13% above COMEX futures prices. Delivery lead times for new 1,000-ounce bars stretched to 8 to 14 weeks. One senior LBMA market maker told Reuters anonymously, and I'm paraphrasing here because the actual quote is striking, that there was no offer anywhere.
Only desperate bids. Wholesale physical premiums over spot prices jumped from the historic $1 to $2 range to a sustained $6 to $10 per ounce. Bank of America became the first major bank to publicly revise its 2026 silver price forecast, targeting $65 per ounce, citing persistent supply deficits and what they called irreversible industrial demand from the energy transition. And then China moved. Starting January 1st, 2026, China implemented new export restrictions on refined silver. Under the new policy, only large, state-approved companies can export silver, and only after obtaining special government licenses. These restrictions effectively froze out hundreds of smaller and mid-size exporters who had been major global suppliers. China didn't do this because silver is just a commodity. China did this because China now classifies silver as a strategic material. Let that sink in. The world's manufacturing superpower looked at silver and said, "We need to keep this." That single policy decision turned a slow-burning shortage into an acute global crisis overnight. Now look, I want to bring this back to something practical, because this is where most financial content fails people. They give you all the drama and none of the clarity. So let me give you the actual framework here. There are basically three ways to own silver. You've got paper silver, ETFs, futures, certificates. You've got silver mining stocks, and you've got physical silver, coins, bars, bullion. And here's the critical insight that most retail investors completely miss when they pile into a silver ETF thinking they're covered. Most silver ETFs do not hold unencumbered physical metal directly allocated to your shares in a simple, clean vault. They rely on a complex web of authorized participants, custodians, sub-custodians, leasing arrangements, and unallocated metal. Under normal market conditions, this system functions fine. Under physical stress, it does not. When physical silver becomes genuinely scarce and lease rates spike, authorized participants may be unable or unwilling to source the metal needed to create or redeem ETF shares. In an extreme squeeze scenario, ETF shares can continue trading on an exchange while the underlying metal has effectively disappeared. You believe you own silver. What you actually own is a paper claim with growing counterparty risk. Major Indian mutual fund companies, including Tata, Kotak, SBI, and UTI, actually suspended new subscriptions to their silver ETFs in October 2025 because they could not source LBMA-certified bars. The system broke in real time for real investors. This is where the psychology piece comes in, because I think this is the most important part of this entire conversation. Human beings have a deeply hardwired instinct to trust systems that have always worked. We trust the banking system because it's always paid out. We trust the futures market because it's always delivered. We trust paper when paper has always been honored. That trust is not irrational, it's actually very rational given historical experience, but it creates a specific psychological vulnerability. When a system has worked for decades, we develop what behavioral economists call status quo bias. We assume the current arrangement is stable and will continue indefinitely, and we systematically underweight low-probability, high-impact structural breaks. The 300-to-1 paper-to-physical leverage in the silver market is not new information. It has existed for years, but as long as the system didn't break, nobody cared. The same way nobody thought much about the leverage inside mortgage-backed securities in 2006, right up until the moment they did. The silver market is not the housing market, and I'm not predicting a financial crisis here, but the psychological dynamic is identical. People ignore structural vulnerabilities until the moment they can no longer be ignored. So what do you actually do with all this information? Here's the practical framework. First, if you have silver exposure through an ETF, understand exactly what you own. Read the fund prospectus. Find out whether your silver is allocated, meaning specific bars are legally assigned to your ownership, or unallocated, meaning you are an unsecured creditor of the custodian. The difference matters enormously under stress conditions. The iShares Silver Trust, known as SLV, for example, uses unallocated silver and relies on HSBC as its custodian. Sprott Physical Silver Trust, on the other hand, holds fully allocated silver. These are materially different instruments. Second, if you're thinking about adding physical silver to your portfolio, understand that premiums and delivery timelines have changed dramatically. Retail bullion coins and bars are commanding sustained premiums of $6 to $10 per ounce above spot. Delivery times from major refiners have stretched to 10 to 14 weeks for large institutional bars. This doesn't mean physical silver is a bad decision. It means you need to price this in and plan accordingly. And third, and this one is crucial, position sizing matters more than conviction. I've seen people hear a compelling macro thesis, get emotionally swept up in the narrative, and put 40 or 50% of their net worth into a single trade. That's not investing. That's gambling with a good story attached to it. Silver has a legitimate data-backed structural case. It also has real volatility. It is entirely possible that the squeeze intensifies and prices blow through $90 or $100 an ounce. It is also entirely possible that the paper markets manage to paper over the shortage for longer than logic suggests they should, and prices stay depressed while the fundamentals slowly resolve. A reasonable allocation for most investors, and this is not personalized financial advice, I am not your advisor, is somewhere between 5 and 15% of a well-diversified portfolio. Enough to matter if the thesis plays out, not enough to ruin you if the timing is wrong. And fourth, watch the numbers that actually matter. Don't watch the spot price. Watch the COMEX registered inventories. Watch the lease rates. Watch the Shanghai physical premium versus COMEX. Those are the real-time stress indicators that tell you whether the physical market is tightening further or beginning to stabilize. Here's the big picture conclusion, and I want you to sit with this for a moment. We live in a financial world that is increasingly built on layers of abstraction, paper claims on physical things, derivatives of derivatives, promises wrapped inside promises. For most of the last 50 years, that system has worked beautifully because confidence in the underlying system was never seriously tested. But every few decades, you get an event where reality and abstraction collide, and when they do, the people who own the actual physical real thing find themselves in a very different position than the people who owned the paper representation of it. Silver right now is sitting at the intersection of three massive structural forces simultaneously: an irreversible industrial demand surge driven by the clean energy transition, a geopolitical fracture that has fragmented the global supply chain, and a slowly unraveling paper market that for years has been allowed to price silver as though physical scarcity didn't exist. When all three of those forces converge, something has to give. The vaults are not lying. Nearly 1 billion ounces of refined silver have vanished from visible exchange inventory since 2021. Not moved, not misplaced, consumed, used up, turned into solar panels and circuit boards and EV batteries, and gone forever. The pipeline behind it cannot replace what has been used anywhere near fast enough, and the financial system built on top of this physical reality has not yet fully reckoned with what that means. You don't have to be a silver bug. You don't have to believe in any particular conspiracy theory. You just have to look at the numbers and follow the logic. And the logic right now says that something structurally significant is happening in this market. And the people who understand it before it becomes obvious to everyone are the ones who will be positioned when it fully plays out. That's the silver squeeze. Do your own research, talk to a financial advisor, and make decisions based on your own situation. But whatever you do, don't sleepwalk into a market this important without at least understanding what's actually going on beneath the surface. I'll see you in the next one.